Hello and welcome to your Global Markets Technical Outlook for the end of quarter two of 2025. Normal disclaimers apply, and before we get into the charts, let's just remind ourselves that the obvious rarely happens, but the unexpected constantly occurs. And if you take one look at your daily news feed, I'm sure you'll be well aware of that. But let's see how that's affecting the markets right now as we dive straight in to the US stock market and having a look at the monthly chart on a log scale. And well, we're back at new all-time highs once again. And who doesn't like all-time highs again? We corrected, of course, through that Liberation Day tariffs episode. You can see the tail of that candle there tagged the bottom trend line picture perfectly, and then it's gone straight back up through the 6,000 level and back to new all-time highs once again. And I'll show you three ways that that tail pinpointed key technical levels. As we go down into the weekly chart here, there you can see the pullback from the tariff announcements, and it kissed that previous resistance level, which has now become support just above that 4,800 level there, and then straight back up almost in a straight line, really straight through the old resistance line and out into all-time highs and into clear air, really well above that 6,100 level. And on the Ichimoku cloud, well, we often talk about the cloud acting as support and resistance, and once again it did exactly that this time. So if you'd had a limit order sitting anywhere around about that sort of 4,800 to 5,000, you probably would have been lucky enough to capture it as it came through that level. But as you can see here on the Ichimoku chart, we are definitely bullish. We have the price and the green lagging line or Chiku span here, both above the cloud. That gives us a confirmation of being in bullish territory, which we've been really from back in this area here in the middle of 2023. No real challenge to the cloud on the downside. The price not making it through to a closing low below the cloud. And the cloud support now hanging around at that 5,500 to 5,900 area. So all looking very rosy on a price front there. Let's see if the internals under the hood back that up. Looking firstly at the bullish percent index, and you can see here we're sitting at around about a value of 75% of S&P 500 stocks bullish. That's obviously a very healthy number. 3/4 of the index are showing bullish patterns. That shows broad participation in this latest move up. We can see that previously this indicator has topped out around about that 80 level. We're not quite there yet, but we've only just seen a new all-time high. So if the S&P 500 continues higher, we may expect a few more stocks to join in the rally and push that bullish percent higher. Looking at the broader market now across the whole of the NYSE, it is a little bit lower here at 56%, and that does speak to the fact that most of the participation is coming from those big large cap stocks within the Nasdaq and the S&P 500, and as we'll see in a moment, the smaller caps down at the Russell area tend to be not so bullish at the moment. Turning to the discretionaries versus stables, and we do see a little bit of divergence coming in here. Obviously, we've got the broader market sitting at a new all-time high, and yet we've got a lower high coming in here for the discretionaries versus the staples. You could easily make the argument that due to all the economic and political uncertainty, people are just putting off purchase of big ticket items, and I think that would probably explain in a large part what's going on here. On the semiconductor front, they are also slightly below their highs compared to the broader market. Obviously, on the semiconductors front, we're seeing things like supply chain disruptions, a lot of these geopolitical tensions and fluctuating demand cycles as well, playing into the semiconductor area as well. On the home builders, we're seeing really the biggest diversion of all those three of them, where it's right. It hasn't made a new high since October last year, and once again we've got the market making a new high. Especially in the US, we're seeing things like declining builder confidence, rising mortgage rates, increased construction costs, and also the supply chain and labor issues as well, all hitting the housing market or the housing construction sector at the moment. But if we look at the advanced decline cumulative line, we can see it is agreeing with the market and has moved into a new all-time high just as the market is. So that gives us some confidence that there is really broad participation, and while some sectors might be a little bit patchy, overall the picture is generally quite rosy. Bearing out the participation story here, I guess, in the relative performances of the indexes, you can see the Nasdaq 100 powering ahead at about 8%, as S&P's up about 6% for the year, and the Russell bringing up the rear. They're down at 1%. So again, that speaks to the move up into new highs being driven largely by these large growth stocks, the Magnificent Seven, and generally the sort of large cap, especially the tech sector, all sort of driving this market higher. But with the S&P 500 also being up in that level as well, I think that gives us a little bit more confidence that this new all-time high should at least stick around for a while yet. Over on the yield curve, well, we're seeing this has now switched back to the so-called normal shape, where we've got lower rates on the left and higher rates on the right there. Not under normal circumstances, that would indicate that risk is low in the market and things are looking rosy. But if we look at the sort of larger economic picture, the fact that it's now turned normal, it has come from an inverted position to go back to normal, and the significance of that is that these recessions, which are these grey vertical bars here, almost always occur after we see the diversion. So up into this pink area is where the inversion, I should say, where the yield curve has gone inverted, and then when it de-inverts, if that's a word, where it turns more positive again, that's generally when you get the recession is following that. So now we've got this chart's a couple of months out of date, but we're now back down into this white area here, which means that if we are going to get a recession in the US, then it's likely to come any time from now, basically, going forward. On the sentiment indicators and on the put-call ratio, well, we're kind of stuck down on this what's called bullish extreme, which is where we have way more call contracts in the market than open put contracts, and that indicates that the market participants are generally very, very bullish. They think this market is going higher, and that's probably to be expected as we hit all-time highs. Whenever a market hits all-time highs, it's obviously usually quite overbought at that point as well. So whilst this is not an immediate concern in the short term, I think it is a little bit more of a concern in the medium term, because ultimately this chart mean reverts, and it does that by the market correcting and people closing out their call contracts and opening up puts, which will push this ratio higher again. So we are slightly overbought, and that's just something to keep in mind. On the VIX, well, we can see that since those Liberation Day tariffs, we've sort of drifted back down, and we're now back in this so-called low-risk area, hanging around down about 15, which is lowish, but not the lowest we've seen. The VIX can get down to 10, 12 when the risk is really low in the market. So the risk is not the lowest it's been, but you can see it is still falling, and that's what we would expect as this market makes new highs. And it's interesting to see, since the last time we did this at the end of quarter one, the feed and greed index was reading extreme fear way back down here on the left, and now we've come full circle over here to the extreme greed. And as you can see from the time series down here, we're actually at the highest reading on this index in the last 12 months. So that does mean we are looking a little bit overbought, and that tallies in with what we're seeing on the put-call ratio as well. Obviously, that can only carry on for so long before eventually what goes up must come down effect kicks in and the market corrects. But again, moving into all-time highs, we would probably expect it to come back and tag the breakout line at some point anyway. On the seasonality, well, on the S&P 500, we can see here that we would normally expect during this sort of first half of the year, if you like, after the sort of corrective phase of January, February, that we would push higher, and that's exactly what we've seen. The correction obviously came a little bit later due to those self-inflicted gyrations that the Liberation Day tariffs imposed. We got the low here in the early April, but since then we've sort of made up for lost time, if you like, and we're pushing higher. Generally, what happens through the northern summer months is the market goes quiet, goes into the doldrums as a lot of traders take their summer break. It's hard to know what if that will still hold in today's volatile market, but or volatile news feed, I should say. But given the distance it's come, I think some sort of pause would not be too unexpected. On the monthly averages of the seasonality, we can see that the July is not the number one strongest month. But given that we've had really strong May and June, it's hard to see that we would push that much further ahead during July, but you never know. And then, of course, August, and we're coming into September, which traditionally is the worst performing month. So it could be a mixed picture coming up over the next couple of months. On the presidential election cycle, we are in this so-called post-election year here, which, as you can see, tends to be very, very bullish right up into early August here. And whilst once again the bottom of the correction came a little bit later than the cycle was forecasting, we have pushed higher in line with the cycle. And if the cycle holds, then we could have another month or so of this to go before we see that eventual topping out there. On the decade cycle, well, at the start of this year, it was hard to envisage that the cycle forecast in the year 5 would be one of the most bullish years, would actually eventuate. But what we've just seen in the last 2 or 3 months does make you stop and think that if this market continues, we could see something of this order. So that would be a very interesting outcome for sure. And then lastly, just a reminder that we are in the so-called winner's curse phase of the 18.5 year real estate cycle. We're starting to see headlines like property prices booming in regional cities. You'll see a lot of this, especially as the monetary policy starts to ease. Interest rates are coming down globally, really, and that's obviously going to increase asset prices and in particular real estate. And once they get to a crescendo where they just become unaffordable, then we'll get the collapse, which according to the cycle is due to come next year sometime. Switching now to the Australian stock market, and we are also at all-time highs on the ASX 200. Once again, we had that similar sort of correction, but was obviously heavily bought into as it pulled back there. And within the space of a month, it went all the way down to 7,200 and then all the way back up to 8,100. So that was quite the move. And from there, it's really just been one-way traffic all the way up. It's now sitting at 8,500 and into new all-time highs once again. On the weekly chart here, we can see again it had a nice picture perfect ping where it opened just above that support line, sold all the way down, and then closed just above it once again. So, and who says technical analysis doesn't work? But once again, you can see that lovely V pattern there. One wonders whether we might get a right hand shoulder here to make it an inverse head and shoulders, but regardless, this market is looking very bullish once again. And on the Ichimoku cloud, we can see once again that just similar to the S&P 500, how we did get that support right in the cloud there. No closing candle on a weekly basis below the cloud, straight back up and straight back up again. So we're still confirmed bullish territory, and the cloud now sitting around about that 8100 to 8200 level. Looking comparatively with the ASX 200, we can see, well, it's in the Asian indexes at least, it's the Hang Seng who's forging ahead, up about 18% for the year, which is massive. Next, we've got the Indian Nifty around about 8%. Then the S&P 500 around about 6%, the ASX 100's up about 4%, and the Nikkei is about flat for the year. Next on to the currencies, and the US dollar. Well, the US dollar is obviously sagging quite a bit. I mean, there's a good case to be made for this is just a sideways market, rotating above and below this 100 index level, which is obviously a key level. But you can see just recently in the last sort of 4 or 5 months, we have had quite a bit of depreciation from 110 down to now 97. There's obviously a few things going on in the US at the moment. We've got to this so-called One Big Beautiful Bill, which is massively expanding the fiscal spending and obviously increasing the national debt. We've at the same time we're seeing monetary policy easing. The Federal Reserve expected to cut rates. We've got the political uncertainty, that goes without saying, and then we've also got this trade policy volatility going on, and some sort of global rebalancing, if you like. And you're also seeing some countries drifting away from using the US dollar. China and Brazil doing trades in their own currencies now, for example. So there's a bit going on for the dollar, and that's all leading traders to park their money elsewhere, and leading to less demand for US dollars, and we're seeing that sinking there. So below that 100 level, and there's clearly no technical damage done yet because we're still in this big sideways range. The next key level would obviously be down around 90 for the US dollar. And a weak US dollar generally means bullish for the other majors. The Aussie dollar did find support round about that 60 cents per dollar there. It's now started heading back up. It's still kind of stuck in this 10 cent zone between 60 and 70, but it does favour the upside slightly just at the moment. On the euro, well, the euro's getting the benefit of the weakening dollar, so we're now seeing that bounce off this 105 level, and it does now look like it wants to make another go at this 1.25 level, which would be interesting to see that up there again. And on the Japanese yen, well, just a little bit more sideways really for the yen here. It does seem to be. I mean, it's obviously taken a lot of hits on the way down here. We got that interest rate decision from the BOJ a few months back. That's now at least arrested the fall. We found support down at that 0.0062 yen per dollar, and now looks like it's just consolidating, maybe catching its breath, figuring out which way it wants to go next. And on Bitcoin, well, here's another market back at all-time highs again. We got the first touch of that 109.5 thousand area back in the early part of this year, and then we got the large correction that was in line with the stock markets. Since then, though, it's also gone up like a rocket. Just paused a little bit here, and now it's punched through, and we've got a new closing all-time high. So very bullish for Bitcoin. And lastly, to the commodities. Well, crude oil has been threatening this 64 area for quite a while now, a number of years, in fact. We've seen test and retest, but this time within the last quarter, it has actually punctured through that 64 level, but was immediately bought back up and pushed back above the support line. So now we have a potential bear trap here. Depending on what happens next, we've obviously got a big red candle here, but if this 64 level now holds, then I think we can probably call that little move down a bear trap. On copper, well, this has gone ballistic, hasn't it? It's gone way through that level up top, and if you've been reading the news lately, you'll know that the copper's the next cab off the rank to be hit with massive tariffs by the US. So there's been this rush to buy up copper ahead of that. That's pushed the price way up here. There's also shortages in the supply chain for copper, and on the other side of the equation, there's huge demand because it's a big input to the green tech revolution. And so that is all of those three things are basically feeding into copper, and then we're now seeing copper once again at all-time highs. And iron ore, well, we see weakening demand in iron ore. This is just bubbling along here. It was testing this $100 level here, and you can see just in the last couple of months, it's actually just dribbled below that. It's not really a sort of convincing break, you would call it, but nevertheless, it's now in this sort of 80 to 100 range. So looking pretty weak for iron ore. But the star of the show is the metal that never loses its luster, I guess. It blasted off through this 2000 area back in 2023, and it just has kept going, blew straight through 3000. Just looks like it's taken a little bit of a pause here, but certainly not no meaningful correction that we can see at the moment. So if you've held on to gold all the way up there, hat tip to you. Well played. So just to summarize that, US stocks, the stock market, obviously we're seeing at new all-time highs. It seems to be a very broad-based participation in the move to new all-time highs. Just seeing one or two sectors not keeping pace, a little bit weaker than the others. But it's hard not to be bullish when you see new all-time highs. And same for the Aussie 200. It's also moved into all-time highs. So everybody's excited at the moment. But that doesn't. It's worth saying that anytime a market moves into all-time highs, it also means it's overbought. So just keep an eye on that for any sort of pause that we get back, and perhaps even a retracement back to the breakout level. On the currencies, obviously that weakening US dollar is the big story. That's helping all the other majors look a little bit more bullish. And then we've also got Bitcoin back at new all-time highs once again. And on the commodities picture, well, it's a little bit mixed. We're seeing oil looking pretty weak, the metals looking quite bullish, and iron ore itself looking a little bit more weak as well. That's it from me. If you have any questions, please feel to reach out to me. Otherwise, I will wish you good luck, good trading, and all the best for the next quarter, and bye for now.